Good morning, everybody. I make it around about 11:30, so welcome to the webinar. Today's webinar is entitled An Introduction to the Share Incentive Plan, or also known as a SIP. It'll last for about 30 minutes. There'll be an opportunity to ask questions at the end if you want to do that. And there's also going to be a recording of the webinar made available on our website and on YouTube if you want to visit it afterwards, or if you want to show it to any colleagues. My name's Sarah Anderson. I'm a share scheme solicitor. I've been working in share plans for around about 20 years, focusing almost entirely on share plans for private companies. My contact details are there if you want to contact me at any time, or if there are any particular questions that occur to you after the webinar. This webinar is supposed to be a practical outline introduction to the share incentive plan, rather than particularly technical seminars. So I'll be talking about the key benefits of the scheme, the key requirements, how to operate the scheme and set one up, and I'll generally explain how it works, including an example of how one of our clients used it to best effect. So to begin with, what is a share incentive plan? It's commonly known as SIP. It was created back in 2000, so it's been around for a fairly long time. It's a government recognised plan, what used to be called an approved plan, but now known as a tax advantaged share plan, which is quite a good name for this particular type of scheme, because if it's used correctly, it can result in zero tax rates, both income tax and capital gains tax for the participants, as well as zero NIT rates for the company and the participants as well. So obviously, there are rules that you have to follow to get to that level of tax advantage. So the SIP has to be made available to all employees, and it does involve actual share ownership with shares held in a trust for the employees rather than share options. But within the limits of those rules, actually, the scheme is quite flexible in the way it works. It allows you to gift shares to employees, or it allows employees to buy shares. And it also incorporates a bog-off arrangement, actually a buy one, get two free arrangement, whereby if employees buy one share at a pre-tax salary, they can be given up to two further free shares under the scheme. And the plan is intended to encourage long-term motivation and reward for employees. The legislation does actually state that it's intended to provide employees with a continuing stake in the company. So if that is your intention, then SIP is your go-to plan. The key benefits of the share incentive plan, we'll start with tax. I mean, obviously you should never implement a share plan just for the tax benefits, but it is undeniable that the SIP is absurdly tax efficient. So there's no income tax or national insurance contributions to be paid by the employees if a share is given to them. And if they buy shares under the plan, they will buy them out of pre-tax salary. And once the employee sells their shares, assuming certain rules are followed, there's no capital gains tax to pay either. From the company's perspective, no NICs to pay includes employers' NICs as well as employees, so that is a saving for the company which can be quite significant. In addition, there's corporation tax relief for the company, so you can claim a deduction for the cost of setting up and running the plan, plus additional reliefs related to the value of the free and matching shares given to employees. And sellers can also obtain tax relief on capital gains if they sell their shares to the SIP. Again, certain rules apply. So you can see that the tax benefits are quite significant for this plan. Another key benefit is the flexibility of the scheme. SIP does really offer a huge amount of choice in the way employees can acquire shares. They can be given free shares up to a value of £3,600 each year for each employee. They can buy up to £1,800 worth of shares out of pre-tax salary. Those are known as partnership shares. Again, that's a per annum amount. And as I mentioned before, they can get up to two further free shares for every partnership share that they purchase, and those are known as matching shares. If you add all those together, and some companies do use all of those options together, you've got a maximum allowance of £9,000 worth of shares per participant per annum. And if they were allowed that full £9,000, the only amount they would be paying is for the partnership shares, again out of the pre-tax salary. One of the advantages I like about SIP is that you can mix and match these things. Some companies start with just free shares, or they might say a partnership share with a 1-for-1 match. It's very, very flexible. You can choose how to set it up depending on the requirements of your business and your employees. And importantly, you're not stuck to one particular way of delivering it on an ongoing basis. You can change the type of awards each year. So that is quite a flexible way of getting shares into the hands of your employees. Another benefit that's really important, especially for private company owners, is the question of control. Even though it's an all-employee plan, that doesn't mean that you're giving up control of your company and handing everything over to your employees. So for starters, you can use non-voting shares in the scheme. Didn't used to be able to, but you can now. The awards are only going to be made in accordance with the company's wishes. So there's always control over the number of shares that you're going to be giving to employees or allowing them to buy. You can, if you choose, just set up a SIP and make one single award and then not make any future ones at any point in the future. It's entirely up to you. You can limit the number of shares people acquire each award. Importantly, if people leave, you can get the shares back. So shares that have been given to them free can be forfeited, and other shares can be, you can ask employees to sell them back, typically to the SIP if they cease employment. So you don't need to worry about ex-employees holding shares in your business. You can get them back from them, and then you can recycle those shares bought from leavers for future awards that you want to make. So pretty decent tax benefits, pretty flexible plan, and for the private company owner who is concerned about control, that need not be a worry, provided you organise the way you're making your SIP awards and plan ahead a little bit. So obviously there are certain key requirements for a share incentive plan. I think the most important thing that you need to know about is that you need a trust and the trustees to run it. So the trust needs to be UK based, and it has to hold the shares on behalf of all the employees. It's not a discretionary scheme like any other type of employee benefit trust that you might have heard of. It always has to act in the best interest of the beneficiaries of the trust, i.e. the employees. And obviously it needs to operate within the legislation. So it's quite a good idea to have a trust who's got at least an oversight of how that legislation works. It's quite common to have an independent professional trustee running share incentive plans, especially for larger companies. Although you can run it with independent individuals operating as trustees if that's preferred. The SIP trust does have some advantages other than the tax advantages noted before, especially for private companies. It's quite a good way of ring fencing a certain proportion of shares for your employees. And as I've just noted, you can recycle leaver shares. So rather than going through the rigmarole of issuing shares to employees and then having to buy them back from leavers and cancelling them, you can put them back into the trust and reuse them for future awards. And you can use the SIP as a way of creating an internal market in a private company. If you want to do that, there's an example of how one of our clients did that a little bit further along in the presentation. Perhaps the biggest advantage of the share incentive plan trust, however, excuse me, is that for as long as the shares stay in the trust, so employees don't take them out and hold them in their own names, any gains will be completely free of capital gains tax. So for an employee, there is precious little advantage in taking shares out of the trust because that removes that tax shelter for them. Another key requirement for SIP is that this plan has to be offered to all employees in the company. So the main purpose of the plan is set out in the legislation, and it does specifically say it must be set up to provide employees with a continuing stake in their company. And very importantly, the main purpose of setting up the plan must not be for the avoidance of taxation. So that's quite a key thing to remember when you're thinking about setting up this plan. The legislation says that you really must be setting up for genuine reasons and to make your employees shareholders in the business. So all employees have to be included. If you've got a group company, you can include some but not all subsidiary companies. So you've got a bit of flexibility there. So for example, overseas subsidiaries, the employees in an overseas subsidiary may not benefit from the tax advantages. So there's probably little point in using a SIP for those. So you can exclude them in certain cases, but generally speaking, it's an all employee plan. And those employees, again, generally speaking, must participate on the same terms. Now, that doesn't necessarily mean that you have to give all of your employees exactly the same number of shares, but you do need to make sure that you don't end up with higher paid employees being the main beneficiaries, or directors being the main beneficiaries, even inadvertently. You can vary the number of free shares given on the basis of salary paid, or hours worked, or length of service. There's a financial limit, of course, on the partnership shares of £1,800 per annum, so it's quite difficult for higher paid employees to benefit disproportionately on that basis. So there's a kind of self-managing limit for the partnership shares to stop you benefiting some people on a higher basis than others, unless, of course, you said everybody's got to buy £1,800 worth of partnership shares in 1 month only. Clearly, that might be a little bit difficult to get around, but generally speaking, the limits for the partnership shares are quite low. So it's difficult to argue that only the very richest people can afford that if you're doing it on a monthly basis or something. You can set a qualifying period of up to 12 months, which is helpful. So before employees are invited to be involved in the SIP, you can make sure that people who are perhaps still on probation aren't necessarily involved. But once that 12 months is up, they would need to be invited as well. And worth noting also that majority shareholders can also participate, of course, as long as they are actually employees in the business. The next requirement you should be aware of is that SIP is a long-term plan. The tax advantages only apply if the shares really are held for 5 years or more, and there will be a clawback of the tax benefits if shares are held in trust for less than 5 years, including a potential income tax and national insurance contributions clawback, which will be based on the value of the shares, either at the market value of the time the shares are taken out of the trust, if it's within 3 years. If you leave them in for a bit longer, the tax charge will be based on the value of the shares at the date of award, or the date taken out of the plan, whichever is the lowest. So that the clawback becomes less harsh as time goes by. And it is also worth knowing that there are rules in the legislation for employees who are treated as good leavers. A good leaver is set out in the legislation. It typically includes somebody who has retired or been made redundant or become disabled or too ill to work. Somebody who's a good leaver will not suffer that income tax and NICS clawback if they take shares out within the 5-year period. Also, if the company is sold or taken over, provided it's for cash consideration, and shares are taken out of the trust as part of the sale, again, there's no clawback in that situation. But generally speaking, keep the shares in the trust for 5 years or more, then it should be fine, and there shouldn't be any clawback applying. So how do you set up the trust? Well, there are some must-haves and some nice-to-haves. You will definitely need some of the items on the left. So we like a bit of a design blueprint, so you work out, crucially, how much of your share capital you're wanting to use in the SIP. You want to think about what type of shares you're going to use, just free shares, just partnership shares, partnership and a match. That very much vary very much depending on your employees and what you're actually wanting to achieve. So I think the commonest approach is using partnership shares with a match, maybe 1-for-1. But sometimes our clients will kick the plan off with a free share award to get people interested and get them motivated and used to joining in the plan at an early stage. It's very much up to what you want to do. You'll obviously need to think about timing. Can take a little while to set these plans up because there's quite a lot of things to organise, including, for example, setting up an account, a bank account for the trust, which can take longer than you would ever imagine in some circumstances. In terms of paperwork, you will need a set of plan rules, which needs to comply with the legislation, and a trust deed, which is usually attached or incorporated into the rules of the plan. And you will need a trustee to operate the trust. So it's the trustee's job to make the share awards to the employees and to hold the shares on behalf of the employees and to buy shares back when people leave, if that's needed. And the trust does need to act within the rules of the plan and in accordance with the employee's best interests. And it also needs to take instructions from the company's directors. So, for example, imagine you've got your directors resolving that they want to make a free share award to all employees in April, and the trustees will put that into operation. But if the directors decide they want to make an award only to certain key employees, the trustees can't do that because they'd be operating outside the rules of the plan and the law. So it's really important that any trustee you choose has an understanding of how the plan should work and their duties as trustees of the SIP. So again, I mentioned earlier, there's no harm in having individual trustees, including trustees from the company, as long as they've got an understanding of what the law is, so they don't inadvertently break the plan and work against the law. I've mentioned the bank account for the trust. The trust needs to be funded. We'll usually need money to subscribe for shares in order to make the awards, and it will also need funds to buy shares back from leavers. If employees are buying partnership shares, then the trust will need to use their salary contributions to buy the shares as well. You will typically need approval of shareholders and board resolutions to adopt the plan and agree when awards are going to be made. And the trustee, if it's a corporate trustee, will also need its own board resolutions to record decisions that are being made. The partnership and free share agreements are the agreements that employees enter into if they want to participate in a SIP offering. Of course, they don't have to, but if they do decide they want to buy partnership shares, they'll need to agree how much money they want to set aside, and the agreements will also contain information about what happens if they cease employment. For example, will they forfeit any of their shares? If they don't fill in an agreement, they can't participate. So you do need that bit of paperwork to make it work for individuals. Employee comms documents are good, of course, frequently asked questions. You will need a share valuation agreed with the revenue. The revenue specialist valuation division will agree a share valuation for the purposes of award of SIP shares. Obviously, that's important if it's a listed company, but for private companies, that is quite essential. And we also like to see, especially if partnership shares are being involved, a nicely organised payroll department so that we know exactly who's going to be buying shares and how to communicate with them and make sure that all the details are up to date. So we're not missing anybody who might be able to participate in the scheme, but they've dropped off a list somewhere internally. You might benefit, in addition, from amendments to your Articles of Association, just to make sure that your company is set up appropriately to operate a share plan. You might want detailed equity modelling if you're looking to make awards over a long period of time to make sure you're taking account of likely number of leavers and what the limits are that you want to give away under the plan. An independent trustee administrator can be helpful. And one thing that's really important, I think, for a SIP, because it's a long-term plan and it might involve employees buying shares and using their actual salary to buy shares, however tax efficiently, you need a decent employee communication strategy, and that is best really tailored to your workforce. Sometimes we'll go around to different offices or different factories for our clients and do individual presentations to different parts of the workforce to make sure they understand what the offering is, what the advantages are to them, and whether or not they feel they should join in. So in terms of setup, that's kind of the starting point, the key things you'll need. Just a brief example of how the plan usually operates in practice. So firstly, company sets up the SIP trust and the share plan itself with the rules. Then employees are invited to participate, usually with the issue of a free or partnership share agreement or a mix of the two. And then employees will accept entering into that agreement and, if appropriate, agreeing salary deductions for the partnership shares that they will buy. The company will issue the shares or the funds to the trust as required, or you can have a founder selling to a trust or the trust buying shares from a seller if that's required as well. And over time, the trust now holds shares on behalf of those employees, and over time can pay dividends to the employees if dividends are payable, and shares can be sold back to the trust by leavers and recycled for future awards. So that's just kind of simple layout of how the trust will usually operate on a day-to-day basis. As far as an ongoing operation of the plan, as I said, the share plan, the SIP plan, is a long-term arrangement. So you need to be keeping track of it over time. And because of the tax advantages, of course, it's important to make sure that it's operating correctly. So the company will need to register the plan with the revenue on their online employment-related security system. And that will include submitting an annual return for the share plan each year, which needs to be done by the 5th of July. And in order to complete the annual return correctly, you do need to keep good records of the awards that you've made, people who've left, the date of leaving, the reasons for leaving, so you know whether they're going to be a good leaver or not. Good idea to keep records of all correspondence with the revenue, especially valuation agreements. And of course, the company will also need to liaise with the trustee itself throughout the process, including funding the trust if required, letting the trustee know when awards are going to be made and on what basis. Meanwhile, the trustee will need to submit a trust return each year. Crucially, ensure that it's always acting in the best interest of the beneficiaries, and generally ensuring that it acts in accordance with its powers and duties. So a very important thing of that is that the trust must not pay more than the market value for the shares, and that's why it's really important to get that valuation agreed with the revenue to make sure that the trust isn't paying too much for the shares. I wanted just to talk really quickly about a case study for one of our clients, which demonstrates how a SIP can operate very successfully in a privately owned business. In this particular situation, we had the Heron family who owned 100% of the company, Heron Limited, for the sake of argument. And Mr. Heron, he didn't really have any particular plans to sell the company. It was all ticking along quite nicely. He did need to establish a succession plan, which he was vaguely thinking about, but potentially passing on to the next generation of directors. He was very keen on strengthening the commitment and loyalty of the whole workforce, and it was very important to him that there was a clear economic benefit for any of the participants in the share scheme. So he's really focusing on the long term. He wasn't looking for a quick sale or to make a quick buck. He wanted to do his best by the employees. He wanted to make sure that the company was operating successfully with committed, loyal employees. But he also, to be fair, wanted to retain a significant interest for his family, including his children. So those were his key objectives. So we helped set up for him an all-employee share plan by way of a share incentive plan and a SIP trust. And he just wanted to give employees free shares. He used the measurement for free shares, which is based on length of service and salary band. So the free shares weren't being given out completely equally. He had a points-based system to work out what was a fair and appropriate way of delivering those shares. When people left, the shares are recycled through the SIP trust, and employees also had the choice of selling shares back to the SIP if they wanted to do so over time, and if the SIP felt that was an appropriate thing to do at an appropriate market value. The SIP always, of course, bearing in mind that it couldn't just keep buying shares back from employees forever. It needed to make sure that it was going to be making future awards and those shares were indeed recyclable. So this is pretty much how it worked. Mr. Heron sold shares into the SIP, reducing his percentage. The SIP's percentage increased as it bought shares from Mr. Heron, and the employee's interest via the SIP increased as free shares were awarded. And free shares went back into for recycling over a period of time. The company also had separately an employee benefit trust and some EMI options for some of the key directors. But for the purpose of this presentation, I'm just really focusing on the all-employee share plan that they used. And it wasn't a very big company. It was only about 45 people. Made free share awards every year over about, a long time, 15 years. We agreed a valuation with HMRC each year. If people left, the SIP shares got bought back at the market value that was agreed with HMRC. Meanwhile, we had an EMI option, an EMI share purchase arrangement going on with the EBT. Occasionally, EBT would transfer shares into the SIP to ring fence for all employees rather than be used on a discretionary basis. And every year, everybody got dividends. And it ticked along very, very nicely. And then one day, Mr. Heron really got an offer he couldn't refuse. And in 2017, the company was sold. So the shareholding at sale looked quite different from what it was before. By the end of the sale process, the employees, including the SIP employees, held the best part of 20% of the shares in the company, and thus on the sale, they benefited from the sale proceeds. But actually, the sale proceeds wasn't really the most important thing. The ultimate outcome was that all herons and the little herons retained a majority interest. There were a couple of key directors who got a decent chunk of the sale. All the SIP shareholders, all the employees who'd been buying and selling from the SIP, all of their gains on the sale were completely free of capital gains tax. So those were the tax benefits and the financial benefits, but really importantly for the owner, he'd managed to transfer a significant part of his shareholding over the period, which is what he wanted to do. As a consequence, he kept staff, for many of them, for much, much more than 10 years. He'd managed to deliver a really strong economic benefit to them by the share market and also by the regular dividend payments, and it had a significant impact on his company culture and reward process. And for us, it's always sad when a company sells because, of course, we lose a client, but his vision was achieved. It was a really excellent outcome for the owner of the business and all the employees. So that was a really good news story and a really good example of how a SIP can really work for the benefit of a business. So that's really a bit of a gallop through share incentive plan. This is the point at which I try to operate the technical webinar bit and ask if you have got any questions, because I believe you can send questions in. I have a question saying, what are the principal differences between the SIP and the EOT? Okay, so excuse me, the share incentive plan, or SIP, is an all-employee plan, and the EOT is also an all-employee plan. But the SIP is more like a traditional share scheme. And it also involves shares which are held ultimately for employees directly. You don't have to have a particular percentage of shares held in the SIP. It's holding shares for employees so they can buy and sell or potentially be part of a sale of the business. The EOT is a trust that holds a majority of the shares in the company on behalf of all of the employees, but the shares don't really go anywhere. They just sit there. It's a way of owners who want to transfer controlling interest in their business to their employees, held pretty much in perpetuity, or at the very least for a very, very long period. And the EOT trust becomes the controlling holder of that business. The SIP doesn't really work in quite the same way. You certainly don't need to have that controlling interest in a SIP. Other main points, I suppose, generally speaking, your EOT is not going to be delivering dividend payments to the employees, because the shares held in the EOT are held by the EOT, not on behalf of the employees directly. It doesn't allocate shares out, it just sits there holding a controlling interest in the business. So if you think of, perhaps the simplest way of thinking about it is a share incentive plan is an all-employee share scheme, but an employee ownership trust is really the owner of a business, more like John Lewis. I don't know if that answers the question. There's lots of webinars about EOTs on our website if you want to find out a little bit more about those afterwards. Can any shareholder sell into the SIP trust at will? There is no reason why. No, they can certainly ask the trust if it wishes to buy their shares, and then the trust would consider firstly what the value was and whether that was an appropriate value for the SIP to pay, and the SIP trust would also need to consider what it was going to do with those shares. So, for example, let's assume we have a SIP running in a company. The company decided they wanted to make a one-off award in 2018 to get shares broadly into the hands of their employees, but there's no intention to make any future awards under the SIP. If a shareholder then comes along and says, I want to sell 5% or 10% or whatever of the shares into the SIP trustees need to think about what they're going to do with them. If there's no way of the shares really being delivered out to employees in the future, then they would have to think about that carefully. But in principle, I don't think there's any reason why a SIP can't sell why a shareholder can't sell into a SIP at will, providing that the trust is happy to do that. Can the SIP work alongside the EMI, and how? Yes, a SIP can work alongside an EMI. In fact, the case study I've just used did exactly that. The company used the share incentive plan to give free shares to all employees on an equal basis, but there were some key directors who they wanted to give a larger amount of the equity to. So the EMI granted options to key employees. It's easy, for example, to use performance conditions in an EMI as well. So they're separate share plans. You operate them. You can operate them alongside each other. You can use the same valuation. Actually, with Heron, we used the same SIP valuation for the award of EMI options, which made sense because they were obviously the same class of shares, same company, same minority interests. So the SIP was a kind of equality for all type plan, and the EMI was a serious motivator for the senior directors. So yes, you can, and I hope that answers your question. I'm struggling with the size of these questions here. Let me see. My understanding is that the number of shares could differ depending on... Oh, then it runs out of words, so I don't know. Oh, depending on level of... Sorry, I'm not doing very well at the... I can't see what that says. My understanding is that the number of shares could differ depending on level of something or other. I can't actually read that. Let me just see if I can make it a bit bigger. Okay, so the number of shares, okay, let's think about how the number of shares can differ in SIPs. Obviously, it will depend on the valuation in part. So, you know, if your shares are worth £1,000 each, you're not going to be able to award more than one share a year if you're using partnership shares, or maybe 2 or 3 shares a year, depending on if you're using free shares. I'm not quite sure, unfortunately. I'm really sorry, I can't read all of that question. So I'm not sure I can quite answer the question there. But you can differentiate. You can set a certain number of shares. So, for example, we have a client who makes an annual award of shares under the SIP, and they just want to limit the numbers. So each year they say we're going to give away, for the sake of argument, 5,000 shares to employees each year, and then they divide that number up by the number of employees and decide how much they've got to give each person on an annual basis, and that is driven partly by the valuation that's agreed with the revenue. So there is a bit of flexibility on the SIP. The crucial thing is that you do need to kind of treat everybody fairly. Let's see if there are any other questions. Work alongside EMI, SIP, EOT. When talking about giving free shares, how does that get around the tax liability of gifting shares of value? That's because it is a SIP. The SIP legislation specifically allows you to give shares with value to employees without any tax liability arising. You're absolutely right. You can't do that normally. Normally, if you give an employee a share that's worth £5, HMRC will go, you've basically given them money's worth of £5 and we'll have some tax on that, please. If you give a share to an employee that's worth £5 under a SIP, no tax arises, no national insurance contributions arise because it is a share incentive plan. The only way a tax liability might arise is if that employee ceases employment within 5 years of acquiring those free shares, in which case there may well be a tax liability at that point. So hopefully that answers that question. Does the SIP trust gain funds solely from employees buying in? Otherwise, where does the money come from? It would have to come from the company. The company would have to fund it, and usually the company needs to have sufficient distributable profits, certainly if it's doing free shares, because obviously it hasn't got enough money to fund the trust. But that's one of the advantages of partnership shares, actually, of course, is that employees will do a lot of funding. Where does money come from? thereby it is only driven by sufficient employee demand. Yes, that is correct. I mean, if you just did partnership shares, you were hoping employees were going to fund the SIP and not enough people wanted to do that, then that would be a difficulty. And that comes down, I think, again, to the blueprint and the design discussions at the beginning, and also potentially discussions with your employees at the outset. If you're putting in a share incentive plan, it's, as I say, a reasonably long-term plan. You need to make sure you're getting it right. You don't want to be paying fees to run a SIP over a period of, say, 5 years and nobody being involved in it, because you still have to pay the trust fees and you need to do the annual returns and so on and so forth. So it is well worth, if you're concerned about that, thinking about the likely level of interest, at least at the outset, for the plan. Cost of setting up a SIP versus EOT, that is too big a question for this webinar because it will depend on so very many things, and it will depend, in the case of an EOT, on the value of the company which is being sold to the EOT. A lot of cases, I think there are some really helpful webinars on our website about setting up an EOT and how you might finance it. With a SIP, the costs will depend very much on the number of participants who are involved, the type of shares that you're going to use. So, for example, awarding free shares is significantly less complicated than awarding partnership shares with a 2-for-1 match and some free shares on top of it. So you need to think about the complexity of the plan and how often you're going to be making awards, because, of course, awards twice a year are likely to cost more than awards once a year. I'm very happy to, if you specifically want to talk about a SIP for yourself or for a client, I'm really happy to talk to you offline. Because if I can find a bit more detail about what you actually want to do, then I can be clearer about what it's likely to cost. So I think the best way to deal with asking me about cost of share plans is actually just to give me a ring. I'm really happy to speak to anybody about share schemes for hours if necessary. So that was a lot of questions, which is great. So thank you so much for those. I am over time now, so I probably ought to wind up. But as I say, please do ring me or drop me an email if you've got any other questions about SIPs or indeed EOTs. I'd be very happy to talk to you about them. But I probably ought to wind up. Just in conclusion, I suppose the key things that you need to know about SIP is that if you want all employees to own shares and have the benefits of owning shares directly, including dividends, and if you are thinking about a long-term share ownership arrangement on a fairly equitable basis for your employees, and if you want the tax efficiency, then SIP is definitely the share plan for you. As long as you're aware that there are limitations in terms of the fact that it must be for all employees, and you shouldn't necessarily put it in if you only want it to last for a year or two, because it's probably a little bit more long-term than that. Bit of a gallop through SIP. I hope you found it interesting. As I say, I'm really, really happy to talk to people on an individual basis if you want to give me a ring. The webinar will be up on the website, so you can have another look at it if you want to. But I think for the time being, I will simply say thank you very much for listening, and I hope you have a good afternoon, and do get in touch if you've got further questions. Thanks very much.